Okay, here's another story we can tell using the asset flow calculator. And you can see here I'm using this earned income and Social Security tab to really show clients how distributions that come from tax advantaged accounts. You can see up here that there's data in this one. I just don't have it included yet. I'll show you how to do that in a second. But to show how distributions from qualified accounts not only cause tax considerations, which a lot of them we all know that we're teaching on that, but actually can bring Social Security into the taxable equation because of the way that the 50% and 85% thresholds work. So what I did here was put in this year 2018's standard deduction. And the way that this works is it pulls income in. We can put in earned income if we wanted to. We can put in different phases there. But I really just want to show the Social Security piece here and how that works. So Todd put in the Social Security calculator over here where we can ask the client for their benefit at age 66 or full retirement age and when we're going to start it. So in this case, we're starting it at age 65. And the thresholds are in there, which of course might change over time, but we'll see. And what you notice here is if the person has Social Security of $44,000, $44,800 household, and there's a 26.6 standard deduction, well then since that draws that down, half of the Social Security is below the threshold, and there's no provisional income to add to it. There's no Social Security being considered for tax basis. So this person would obviously have we'd be dealing with, we're not worried about taxes there. And we can add it, if we consider taxes here, you can see that the first dollars that would go in after the standard deduction would be hit at the 10% rate, but we don't have to concern there because it's not being pulled in, right? But over here on on my tax advantage tab, I have a 401k, and I have $1 million in that. And I'm just showing that this client might be pulling out, I'm just, for the sake of this argument or story, pulling out $50,000 out of that account every single year. Well, by itself, if we consider there's taxes that could be levied on that account, what this is doing is this is taking $50,000 minus the standard deduction, kind of puts us at that. I'll actually show you, I'll bring this over here in a second. There it is. What it's doing is it's taking the $50,000 minus the standard deduction, and it's showing us what the tax rate on those dollars would be, 485, right? It's in the 10% marginal bracket, but it's 485, and then this is what the taxes would be on that distribution if this distribution occurred by itself. All right, so you can see that here. So we kind of use these two calculators to prove back and forth. But this is only showing this account by itself, because if I hit include, and we also have the include here, the earned Social Security income and Social Security included as well. And I can either hit include here, or I can right click this button up here and turn it green. Now you're going to notice things changed on this tab, because now it's taken into account that there's Social Security income that's going to be countable. Well, wait a second. I thought my client's asking me, I thought my Social Security wasn't going to be taxed. Well, if we go back over here to the Earned Income and Social Security tab, we can see that this calculator nicely pulls in what is now, since the provisional income pushes the Social Security above the thresholds, now there's a calculation that's happening that's showing us how much Social Security is now going to be considered taxable. And then, of course, what the taxes on that would be. And the reason it's doing this is because we have this included, and this is a fully taxable distribution, the $50,000 that's coming out of that. So if I right-click it and take it out, you can see we go back to where we were. If I include it, now we have that here. And just kind of to validate for myself and for the client and for our story, if we have the $30,000 that's now considered taxable minus our deduction, standard deduction, and then we have the $50,000 distribution on top of it, you can see this is where we're running into the $354 of tax on this piece, and the excess distribution is now being hit at $56.90. So let's go back over to that account to see what. Yep, there it is, $56.90 being hit on that account. So, this is just a way for you to kind of start teaching clients. Hopefully, this is helping you see how we can start teaching clients the impact of taxes in retirement, most specifically with how it affects how tax-advantaged qualified plans are taxed and distributions are taxed, and then more importantly, how it plays with other assets and other sources of income. Where it can get really cool is if we start using tax-free accounts or distributions from life insurance and showing how it doesn't affect this. That's where the story can be taken to the next level. Hopefully that helps.